In this video, I'm going to talk about how to account for transaction processing fees. So if you walk into a grocery store and buy $50 worth of groceries, if you pay with a credit card, the grocery store is not going to receive $50 for that transaction. And that's because they have to pay these transaction processing fees. Okay, so they might have fees, for example, of $1. So in that case, the grocery store would actually receive $49 even though you bought $50 worth of groceries. And the question is, how do we account for this? Well, the grocery store is going to record $50 of sales revenue, even though they're only receiving $49. And that difference, that transaction processing fee, that's going to be recorded as an operating expense. Okay, so these transaction processing fees do not reduce sales revenue. The grocery store would not record $49 of sales revenue. They record the full $50, but then they record this expense. So let's do an example. Let's say that you hire a professional Santa Claus to do a video chat with your children for $100. You pay with a credit card, and so Santa gets hit with a 3% transaction processing fee. So 3% of $100 is $3. So Santa's only actually going to get $97. So in terms of the journal entry, Santa would debit cash, increase the cash account for $97, and then debit a merchant fee expense, or you could have credit card expense, credit card fee expense, some account here that is an operating expense that represents this transaction processing fee that Santa is incurring. And then Santa is going to record $100 of sales revenue. So again, even though Santa is not getting the full $100 because of the transaction processing fee, because you paid with a credit card, Santa is still recording a $100 sale. Now, you might be wondering, hey, well, does Santa immediately, in terms of the transaction processing, does Santa immediately get the $97? No, it might be a day or two before Santa gets the money with the whole transaction processing. So you might think, well, hey, why don't we just record an account receivable here instead of cash? You technically could do that, but most situations, it's just easier just to increase the cash account because Santa's going to receive that money pretty quickly. Now, alternatively, you might see some people actually break this journal entry into two separate journal entries where you debit cash and credit sales, and then debit the merchant fee expense and then credit cash. So either way, you're getting to the same place. Okay, so the key is there's $100 of sales revenue, even though Santa does not receive $100 of cash here. Now, you might be wondering, well, what if Santa adds a surcharge? Okay, so in the United States, there are some states that allow the company to add a surcharge to basically recover these transaction processing fees. So Santa could say, well, look, hey, if you're going to pay with a credit card, then I'm going to charge you a fee of 3%. So then if I say, okay, well, I'm going to pay for this $100 visit or video chat with Santa, but I'm going to pay with a credit card, then I actually have to pay Santa $103. Okay. So from the customer's perspective, basically the price has gone up. So Santa's basically charging more money if you're going to pay for a credit card so that Santa isn't out that money. So let's say that Santa adds a 3% surcharge for any credit card sale. So I got here credit sales, credit card. Okay, surcharges don't apply to debit cards or cash transactions. In the U.S., you can only have a surcharge for a credit card purchase. So in any event, let's say, so the customer here, if Santa does this 3% surcharge and you pay with a credit card, it's a $100 video chat, you're actually going to pay $103 because you're going to pay the $100, but you're going to have to pay the 3% surcharge on top of that. So now so the transaction from the customer's perspective, the customer is actually paying $103 now. So Santa is going to record now $103 of sales revenue. Okay. Now, but remember, Santa has to pay that merchant fee expense. So here, I'm assuming so again, the agreement, so Santa's going to have an agreement with the transaction processing company of how the merchant fee expense is actually calculated. Okay. So it's going to vary based on the terms of the agreement. Let's just assume here that Santa has the agreement where the 3% will come off of the actual price of the video chat, the 100, and that it's not now 3% of the 103 that the customer's paying, because that could be the case. But to keep things simple, let's just say it's still 3% of the original $100 price. So then Santa's going to have merchant fee expense or credit card expense of $3. Okay, but now Santa's going to record 103 of sales revenue, okay, because that's what the customer, they're actually charging the customer 103, but they're charging them $3 extra to account for the $3 expense that they're going to incur, so that basically this has no effect, that expense has no effect on Santa's profit, and then Santa's going to debit cash for $100. Now, one final thing that I didn't mention in the example above, I didn't mention anything about the sales tax. Now, in the United States, so a lot of most states have a sales tax. It doesn't apply to all types of transactions. A lot of times it doesn't apply to services and so forth. But let's just say that there was a sales tax that applied to this transaction. So the sales tax generally, when there is a sales tax, it applies to both the purchase price, so in this case the $100, as well as the amount of any surcharge, which would be $3. So if this was a scenario where there was actually sales tax applying, I just wanted to note the sales tax would generally be calculated based off of the 103 and not the 100.